Hi, everybody. It's Jessica Stone at Stansberry Research, and I have the pleasure now of Dan Ferris, the Extreme Value Editor. He is joining me to talk about two big numbers that could really mean money for investors. And those two numbers, Dan, I believe, are the 10-year Treasury yield and the S&P 500 dividend yield. What
Correct, Mundo.
do those figures, those phrases mean?
Well, the S&P 500 dividend yield is just if you add up all the dividends of the S&P 500 stocks and you divide it by all the share price of the S&P 500, that's the percent yield. Then there's the 10-year yield, is the yield on the benchmark United States 10-year Treasury bond.
All right, so we've
So,
got these
yeah.
two numbers, and it's really the relationship between them that you've been looking at, because one, it sounds like, indicates how much you can make in stocks versus how much you can make in bonds, or how much you can expect to make, right?
Pretty much, yeah. Yeah, that's one way of looking at it.
And what are you seeing in terms of the relationship between how much you can make in bonds and how much you can make in stocks?
Well, simply put, you're making a lot more yield in stocks than you are in bonds. That's the simplest way to put it. In fact, you're making more than you've made between those two, the relationship between those two, since 1942. So that's a pretty long time. And that difference, it went down and down and down and stayed really low for a long time. Well, then we had this COVID-19 thing, and the Fed pushed interest rates way low, so that caused the ratio to skyrocket. And right now, the S&P 500 dividend yield is roughly between 3 and 3.5 times the 10-year yield. So, in other words, by that measure, stocks are more attractive than they've been since 1942, which is kind of a long time. This is a much different time than 1942. In 1942, stocks were dirt cheap and investor sentiment was in the tank. Nobody wanted to own them. And nowadays, of course, stocks have been on a huge, more than a decade bull run. We've had some volatility, but we're sort of heading back up near all-time highs. And they're much more expensive, like 11 or 12 times earnings in 1942 versus 30 times, or more than 30 times today. So,
And I'm guessing for a guy who edits a publication called Extreme Value, that's a problem, right?
well, it is if you think you can put all your money in the stock market and leave it there for the next 10 years and not go sideways or even lose a little bit. So, yeah, yeah, that's a problem. I think it could potentially be a big problem because what really tends to happen is, people put some money in the stock market and leave it there for the long term, like in a 401k, but a lot of them are, they're playing fast and loose. They're managing their own accounts. And what they will do is buy right now because they think it's really attractive and stocks have been going up. And they'll sell out at the bottom. If we get a big 20, 30, 50% drawdown, they won't ride through it. They'll lose half their money and sell out at the bottom.
So when you look at this data, do you
So
think
it's
this,
really,
when you look at this data, do you interpret it to mean that people should be not only more careful with their stocks, but more bullish on bonds?
no, not more bullish on bonds. In fact, I think this whole relative idea is bankrupt because what we're saying is bonds are a huge stinking pile of garbage that you should avoid. And the S&P 500 just stinks a little bit less. So therefore it's really attractive, and that's crazy. So yeah, definitely not that. But there's another factor here that nobody seems to be talking about. The Fed thinks they're doing a wonderful thing when they push interest rates down to make debt easier to service.
Oh yeah, they want us
Right?
all to spend, spend, spend. What
Exactly.
it's
So
all about.
that's exactly what it's about. It's about stimulating the economy, right? But what they're also doing is making collateral more valuable. So people in
Hmm.
big institutions, they run these portfolios where they borrow money and the collateral is like 10-year treasury bonds and other government securities because they're really safe, so they can get loans against them. And so what the Fed is doing, they're making the collateral more valuable. So what do? Well, if you're running one of those portfolios, the value of the collateral goes up, you borrow more, you buy more. And this is attractive because as long as you're getting any kind of little yield out of the 10-year or whatever government bond you're holding, you're okay. It's not costing you anything. It's paying you a little bit, right? Well, what happens if which I think this is inevitable, what happens when the yields go negative, as they've done in, the same playbook all around the world, in Europe, in Japan, the yields have gone negative because they've been doing longer what the Fed is now doing.
Mm-hmm.
So when the 10-year goes negative, what happens to all those portfolios? Well, it costs them something to hold the collateral, so they're going to guess what they're going to do. They're going to reverse back out of it. And that could lead to some forced selling and some further volatility, if not the beginning of an outright bear market. So don't try to predict and exploit. Try to prepare. So the thing that people need to do nowadays more than ever is to be truly diversified. And truly diversified means you're holding things that will behave differently when other things are, when your stocks are falling, you should have a big chunk of cash at this point. Gold and silver are part of it. That's part of true diversification, because with stocks and cash, you're inside the financial system. Mm-hmm. With gold and silver and even a little bit of Bitcoin, I would say, is a good idea. You're outside of the traditional financial assets. So that, to me, that's the basic, truly diversified portfolio. Stocks prepare you for, good times ahead. Cash, gold, silver, Bitcoin, they prepare you for, volatility, and they protect you and help you preserve value.
All right. We got a prescription to ride the roller coaster from Dan Ferris there, editor of Extreme Value. And if you would like to be directly connected to Dan Ferris's thinking and all of his publications, you can hover on the screen now and hit that subscribe icon. Also, please join us on YouTube or Facebook, Instagram, LinkedIn, and Twitter. That's all for now. Thanks for watching.